Well, quite a bit of technical damage has been done, and there were all sorts of leading indicators ahead of what happened yesterday. You know, whether you look at the home building stocks down 30%, the relative strength of the financials actually peaked about 7 or 8 months ago, and we're giving us a little bit of a signal that you know, we could get another round of corrective activity, which is what we're seeing right now. You know, but the one thing I would just say is this: you know, we always focus on the U.S. stock market. The market is a global market. You know, we talk about an economy, a global economy. It's also a global stock market. And if there's anything we've learned from the Asian crisis in '98 and from the last cycle, is that there's no such thing as global decoupling. I just think that everybody seems to base their thoughts on the stock market based on what the S&P 500 is doing. But there's another 70% of the world out there. And heading into this negative action in the U.S., the ex-US global MSCI index was down 15% from the January highs. So I think to some extent we're seeing some lags from the rest of the world hit the US stock market right now as the S&P catches down to the rest of the world.
Jurrien, you say that yesterday's sharp decline left the market quite oversold technically, and been all over the place so far this morning, but right now down 227 points on the Dow, the S&P down almost 1%. Your guess is that we stabilize here. Do you think this is the day we stabilize, or do we have to see how the rest of this week plays out?
Well, I mean, that's a very short-term focus, of course, but yesterday the market did get short-term technically oversold. You know, I saw one proprietary sentiment survey that showed 0% bulls. If you look at the number of new lows, you know, we are at the 200-day moving average. Volume spiked, you know, et cetera, et cetera. So there's certainly anecdotal evidence that on a short-term basis the market got oversold. Whether that means we have a low today or tomorrow or yesterday, you know, I mean, who knows, of course. But you know, the bigger picture is we're in a range. We have been in a range since January. That's now 9 months ago. We kind of went to the upside of the range around S&P 2900. We spent some time there. We're kind of now back below it. The lows back in February were 2550. We're nowhere near that, but you know, we're somewhere in a range, and that's exactly what the market should be doing per the discounted cash flow model. You know, when earnings are strong but starting to decelerate, and liquidity conditions are tightening because the Fed's raising rates. We have a policy divergence in terms of monetary policy between the U.S. and the rest of the world, making the dollar go up, making financial conditions tighten up. When you have the intersection of those opposite movements between the numerator and the denominator of the discounted cash flow model, you get a market that can no longer go up at the rate that it was back in 16 and 17. And as a result, we have this prolonged period of indigestion as the market kind of, you know, consolidates based on these different dynamics. And my guess is that we're gonna keep doing that for a while until we get closer to the end of the Fed cycle, which, as we've learned in recent weeks, is we're not near yet. So I think the market's doing exactly what it should be doing. Whether that means it should be going down 800 points in one day, obviously I don't mean that. But the market should be treading water, and that's basically what it has been doing since January.
And David, we've been talking a lot about the Fed and about rising rates over the past week. Mind you, those yields on treasuries are lower today. But the other piece of this that seems to be driving some of the action we've seen this week is China and trade tensions starting to affect more companies. PPG, Fastenal, LVMH, Trinzio, just in the last couple of days making comments or lowering guidance based on those trade tensions. What are your expectations as we get into earnings season? And do you think we're going to see more impact from the trade situation?
Well, I don't think there's any doubt that we're going to see more impact from the trade side. If anything, the hostilities with China have gotten worse. And you're 100% correct. The whole tenor of this market has changed, and not just on interest rates, but also on earnings fundamentals. So we have a lot of good news priced in. You mentioned a slate of negative guidance. We've also have a situation where the analysts, for the first time in a long time, are no longer raising their earnings estimates. We're seeing evidence of large-scale insider selling, and the ETF inflows have really dried up substantially. So that's a negative fund flow impact as well. My sense is that it's not so much a valuation story. I think it is largely a liquidity story, but not just from the Fed's perspective. But consider what China's doing. China and Japan, by the way, together own more than $1 trillion worth of Treasury notes and bonds. And it looks as though they're showing up at the auctions a lot less than they were before. One of the reasons why the market has some jitters, it's not just about the Fed. You had a couple of bond auctions just this week that didn't go so well. The bid cover, subpar. The street has been left with a lot of the 3 and 10-year product on their books. So right now, the street's very heavy in terms of bonds. That's going to put upward pressure on yields once the dust settles. So there's a lot of confluence of factors out there right now that are just causing a higher level of uncertainty than we had previously. And that's one of the reasons why the stock market's reacting the way that it is right now, is because of liquidity concerns and the new general high level of uncertainty out there.